Hey everyone, and welcome back to Stock Talk.
Great to be here.
Today we're diving straight into Brookfield Corporation. They just dropped their Q1 2025 financials on May 8th.
Yeah, we've got the official analysis right in front of us.
And our plan today is pretty straightforward. Dig through this report, pull out the key insights for you so you get a clear picture of how Brookfield's doing and maybe what's next.
Exactly.
And hey, if you find these deep dives useful, do us a favor, subscribe, like the show, maybe share it with someone who'd be interested. It really helps us out.
Definitely appreciate the support.
Okay, so let's get into it. The headline number, it certainly grabs your attention. Distributable earnings up 27% year over year.
Yeah, a big jump. Hit $1.5 billion, which works out to 0.98 cents per share.
But what's interesting, and you pointed this out earlier, is if you look at it before realizations.
Right, the sort of core operational profitability. That was up even more, 30%. Came in at $1.3 billion, or 0.882 per share.
So that really highlights the underlying business strength.
Precisely. Day-to-day operations look very strong. Okay, but then you see net income actually went down. $215 million. How does that square up?
Yeah, that's a key point. It often catches people. While net income dipped, that big jump in distributable earnings shows the cash-generating engines are running really well.
So it's an accounting thing?
Largely, yes.
Yeah.
It often comes down to how and when asset sales, those realizations we mentioned, get recognized under accounting rules. They can hit net income differently, sometimes creating a bit of a disconnect from the steady cash flow that distributable earnings track.
Okay, so realizations are when they sell off an asset they've been holding or managing.
Exactly. And while that brings in cash, the profit recognition for accounting can be lumpy, so for investors really focused on that consistent cash generation, maybe for dividends, distributable earnings is often the more watched figure here.
Got it. That distinction helps. So, okay, let's dig into those cash engines then. Asset management seems like a real bright spot.
Oh, absolutely. Firing on all cylinders there. Fee-related earnings hit a record $698 million. Yeah, up 26% from last year.
Yeah.
And that's crucial because it's income from managing other people's money. Very steady, high-margin stuff.
And they pulled in $25 billion in new money just in the quarter.
Huge number. A massive vote of confidence, like you said.
It really is.
And connect that dot, their total fee-bearing capital, the pot they earn fees on, is up 20% over the past year. It's now at $549 billion.
So that growth just keeps feeding those fee earnings.
Directly. More capital managed, more fees earned.
Okay.
Simple as that, conceptually.
They mentioned some big fund closes too, right? Something about credit and real estate.
Yeah, specific wins. They closed $16 billion for their big opportunistic credit fund.
Yeah.
And they did the institutional close for their fifth opportunistic real estate strategy.
Those are significant sums. Shows investors are still allocating.
It really does. Even with, all the market chatter, investors are clearly confident in Brookfield's track record in those specific areas. They're putting serious capital to work with them.
Okay, another area that really stood out. Wealth solutions. That saw some pretty incredible growth. What's the story there?
Yeah, that segment is clearly gaining serious momentum. Distributable earnings there jumped, get this, 58%?
58%.
58 to $430 million, or 0.27 per share. It just shows really strong demand for their wealth products.
And their insurance assets ballooned too, $133 billion now.
Big increase. And it's fueled by strong annuity sales. They did $4 billion just in Q1, retail and institutional combined.
And is it stable growth, financially sound?
Seems so. They highlighted having over $16 billion in statutory capital in that insurance business, and they're getting a solid 15% return on the capital they've invested there. So, yeah, it looks like fast and well-managed growth.
Okay, good to know. All right, let's shift gears to their operating businesses. These are the more direct investments, right? Infrastructure, property, that kind of thing. How did they do overall?
Pretty resilient as a group. Combined distributable earnings were $426 million. That's up 26% too. So their core holdings are definitely pulling their weight.
And within that group, it looks like a bit of a mixed bag, performance-wise.
Yeah, some variation. Renewable power and infrastructure, they were both up around 6%. Steady eddies, basically.
Which you kind of expect from those assets, right? Long contracts, stable cash flows.
Exactly. They provide that really solid, predictable foundation, essential services, green energy, generally stable earners.
But real estate, that one jumped out again, up 30% in distributable earnings?
It did. And importantly, they mentioned a 3% increase in same-store NOI.
Okay, explain same-store NOI for folks.
Right. It basically looks at the income growth from properties they've owned for at least a year. It strips out the impact of buying or selling properties, so you see the the organic growth of the existing portfolio.
And they signed a lot of leases, nearly 9 million square feet, including office space.
Yeah, 2.3 million square feet in U.S. office space alone.
Which is pretty noteworthy given all the headlines about the office market, isn't it?
It really is. Suggests demand is still there for the right kind of properties. Exactly. Quality and location still matter, clearly. It's not a disaster everywhere.
Okay, but private equity was down a bit. $6 million in earnings, down 33%. They said ongoing strategic initiatives. Any thoughts?
Could be a few things. Maybe some portfolio repositioning. Maybe they're investing heavily in newer ventures that aren't generating big earnings yet. Or perhaps timing of exits.
Makes sense.
And related to strategy, they mentioned selling off $640 million in North American residential assets. They called it a shift to a capital-light model there.
Ah, okay. So less direct ownership, more managing or advising.
That seems to be the idea. Frees up their own capital while still participating in the sector.
It's an interesting pivot.
Definitely. Okay, let's talk about firepower. Their capital position. Sounds like they have a lot of money ready to go.
Oh, they do. A record amount, actually. $165 billion in deployable capital.
$165 billion.
Billion. Think of it as a massive war chest or dry powder ready for opportunities, especially useful if market prices get more attractive.
How much of that is like actual cash or easily accessible? They specified $69 billion is in cash, financial assets, and undrawn credit lines. So a very significant chunk is readily available. Puts them in a really powerful spot.
And they're using some capital to buy back shares, too.
Yep, $850 million worth repurchase so far in 2025. Usually assigned management thinks the stock is a good value.
Plus the regular dividend.
Right. Declare the quarterly dividend, 0.09 cents per share, consistent return to shareholders.
They also sold quite a bit, $22 billion in asset sales during the quarter. And they made a point of saying it was at or above carrying value. Why is that detail important?
That's a really positive signal. It shows they're not just selling things off, they're selling them at good prices, validating their internal valuations. It also bolsters their capital position even further. Strong execution on monetization.
Okay, so looking forward now, they sound pretty confident despite, everything going on in the world economy.
They do. They reiterated their confidence in delivering 15% plus returns to shareholders. That speaks volumes about how they see their diverse businesses performing.
And they mentioned something about unrealized carried interest. $11.6 billion.
Yeah, that's a big potential future boost. Carried interest is basically their share of the profits from the funds they manage. That $11.6 billion is profit that's been earned on paper but hasn't been cashed out yet. It suggests a significant pipeline of potential earnings realization over, say, the next 5 years or so as those funds mature.
So future tailwind baked in.
Potentially, yes. Depends on continued fund performance, of course.
And their focus areas for the future seem pretty clear. Deploy that capital.
Right. Put that $165 billion to work.
Keep growing fundraising, especially tapping into retail investors more.
Yep. Broadening their capital base.
Expand wealth solutions further.
Building on that huge growth we saw.
And make strategic buys like that Angel Oak deal they mentioned.
Exactly. Angel Oak strengthens their position in specialized credit and wealth management. These all look like logical extensions of their existing strengths and opportunities.
Of course, you always have to mention the risks, the usual suspects.
Pretty much. Market swings, interest rate moves, geopolitical stuff, competition. These are the external factors that could always throw a wrench in the works for any big global player like Brookfield. Always need to keep those in mind.
Right. Okay, so let's try and wrap this up. If you had to boil down the key takeaways from this Brookfield Q1 deep dive, what would they be?
I'd say number one.
Yeah.
Really strong growth in the core earnings drivers, especially asset management and wealth solutions. Number two, the underlying operating businesses are holding up well, showing resilience.
Okay.
But maybe the biggest thing, number three, is that record deployable capital, $165 billion in this market environment. That's huge.
That number really does leap off the page, doesn't it?
It really does, because having that kind of financial flexibility when markets might be choppy or presenting bargains, well, that's a massive strategic advantage. It lets them be opportunistic.
So thinking about that diverse business model they have and that enormous pile of cash, it really makes you wonder, doesn't it? What specific areas, what sectors, maybe even what kind of new technologies might they target next?
That's the billion-dollar question, isn't it? Or maybe the $165 billion question here.
Yeah. And what impact could those moves have, on the wider market?
Exactly. Where they choose to deploy that capital will tell us a lot about their view of the world and where they see the best opportunities. Definitely something for investors to watch very closely.
Well, fascinating stuff as always. Thanks for breaking down Brookfield's Q1 with us.
My pleasure. Always interesting to dig into their results.
And a big thank you to all of you for tuning into Stock Talk for this analysis. If you found it helpful, again, please hit subscribe, give us a like, maybe share the show. We'll be back soon with another deep dive.